Traditional blockchain networks operate under a strict design constraint. Every node must agree on a single global history of data. This architectural choice limits throughput and creates severe friction when processing high-volume microtransactions. Because tokens like Bitcoin rely on global consensus, block space becomes artificially scarce. When traffic increases, users enter a bidding war, driving up gas fees. If a user pays a $5 fee to process a 1-cent payment, running decentralized web applications becomes mathematically unviable. Holochain approaches this problem by abandoning global consensus entirely. It uses an agent-centric architecture, where each user maintains their own individual data chain and only synchronizes with a specific subset of peers using a distributed hash table. While removing global consensus allows the network to scale, a fixed supply token model leaves hosting prices vulnerable to speculation. If hosting demand spikes while the currency supply remains stagnant, the cost of compute power decouples from the price of electricity, making long-term costs unpredictable for developers. This requires an accounting system where currency supply can expand and contract alongside network capacity. HoloFuel functions as a mutual credit accounting framework designed specifically for high-frequency microtransactions. It manages the flow of value between developers and hosts without relying on a speculative, fixed-supply token model. In a mutual credit system, money is created through a double-entry ledger. The buyer's account goes negative by the exact value the seller's goes positive, keeping the net supply at zero. When developers purchase hosting, their negative balance matches the host's new positive credit. Because these credits represent verified hosting work, HoloFuel is an asset-backed currency. The backing asset is the tangible computing power, storage, and bandwidth actively supplied by the network of physical machines. This grounds the currency's pricing logic strictly in real-world utility. Its value derives directly from the capacity of the network to perform computing tasks, insulating it from speculative token hype. By utilizing mutual credit, HoloFuel operates with a breathing money supply. The total amount of currency in circulation expands and contracts dynamically, in direct response to the actual market behavior of its users. There is no algorithm blindly minting coins. Supply only expands when hosts plug into the network, prove capacity, and generate credits by providing compute power. Conversely, when developers pay for hosting, deflationary counterpressure occurs. Credits settle against the ledger, contracting the supply. To understand the floor price of these credits, we have to look at the economic reality of the hosts maintaining the network. Every node operator faces hard physical costs. They incur capital expenditures for their hardware devices, like a Holo port or an edge server, alongside ongoing operational expenditures for electricity and bandwidth. To manage these expenses, Holo uses dynamic pricing. Hosts independently evaluate their own operational costs and manually set the exact rates they are willing to accept for their hosting services. This creates geographic scarcity. If an application requires low-latency hosting in a region with few active nodes, the available hosts in that area will organically raise their prices to meet the concentrated demand. The baseline floor for HoloFuel's market value is therefore strict and physical. It is the global sum of what it costs operators to keep their machines powered on and connected to the internet. The demand side of this equation consists of developers building Holochain applications, known as HAPs, and the end users relying on them for distributed social networks, supply chain systems, and peer-to-peer marketplaces. These developers are seeking an alternative to a traditional global web hosting market that currently generates over $100 billion annually. As the Holochain ecosystem expands, every new application deployed requires more bandwidth and storage, organically scaling the direct demand for HoloFuel. Holo removes extreme blockchain gas fees, but its real competition is baseline pricing from giants like AWS. AWS sets an absolute global ceiling. In this competitive viability zone, a Holo host must undercut Amazon's pricing while staying high enough to cover physical electricity costs. Until the network reaches full maturation and consistent utilization rates, the exact operating margins for independent hosts will remain highly variable. The long-term viability of the Holo ecosystem depends on its ability to compete directly with the profit margins and infrastructure scale of centralized cloud providers. While HoloFuel is the long-term utility currency, the current ecosystem relies heavily on the HOT token, which operates primarily as a speculative asset. HOT is an ERC20 placeholder token launched on the Ethereum blockchain in 2018. It has a capped supply of 17.76 billion and serves strictly as a bootstrap funding mechanism during the network's development phase. The transition swap from the HOT token to native HoloFuel marks the point where the network moves to an operational hosting currency. Holders will exchange their tokens at a 1-to-1 ratio as the peer-to-peer payment system goes live. To manage liquidity between the internal mutual credit system and external fiat currencies, Holo utilizes reserve accounts. These reserves act as a financial buffer. They allow hosts to redeem their earned HoloFuel for national currencies like USD or EUR to pay their utility bills, insulating the internal hosting economy from the extreme volatility of the broader crypto market. The primary risk factor within this model is liquidity. A massive sudden capital flight could drain the reserve accounts, severely destabilizing the exchange rate between HoloFuel and fiat currencies. The transition from the HOT token to HoloFuel represents the ultimate stress test. It will determine whether years of speculative valuation can successfully convert into functional, demand-driven network utility. Before this utility can capture major enterprise adoption, the core technological stability of the Holochain platform must be empirically verified. Market confidence relies directly on the successful execution of specific technical milestones, including the wind tunnel performance tests and the widespread deployment of edge node containers. But even with a flawless technical rollout, the network faces the explicit legal obstacle of jurisdictional regulatory classification. In the United States, there is a looming threat of the Securities and Exchange Commission classifying HoloFuel as a security, rather than recognizing its design as a functional mutual credit utility token. This threat from U.S. regulators contrasts sharply with the clearer legal frameworks emerging overseas, specifically the European Union's Markets in Crypto Assets, or MiCA, guidelines. If clear regulations define HoloFuel appropriately, it unlocks institutional adoption. Legal clarity enables compliant exchange listings, allowing enterprises to purchase HoloFuel safely and trade it on global markets. A highly efficient distributed hash table means very little if regulatory friction prevents legitimate businesses from participating in the economy. Beyond strict financial regulation, the profitability of the Holo network is covertly dictated by external macroeconomic forces. Because hosts cover capital expenses in fiat, global interest rates and volatile energy costs directly dictate whether an independent node operates at a profit. A major geopolitical tailwind acting on the network is the rising demand for European data sovereignty. Enterprises seeking independence from centralized American cloud infrastructure provide a direct macro-level catalyst for Holo's adoption. Internally, the community's governance decisions and consensus regarding future protocol upgrades hold the power to heavily alter these economic incentives. The financial viability of the HoloFuel protocol is tied directly to fluctuations in global energy markets and the outcome of geopolitical disputes over data control. Projecting the network's future valuation requires mapping 3 distinct adoption scenarios. In a conservative scenario, Holo remains a niche alternative to AWS. Developer adoption is slow, and HoloFuel pricing strictly tracks the marginal electricity costs of its most stubborn hosts, resulting in a relatively flat trajectory. In a pessimistic scenario, critical technical vulnerabilities appear during mainnet launch, or severe regulatory crackdowns block exchange liquidity. Both the speculative value of HOT and the utility value of HoloFuel collapse entirely. In an optimistic scenario, the mainnet proves exceptionally stable. Incoming data sovereignty laws push European enterprises into the Holo ecosystem, driving continuous demand for compute power. As the network effect takes hold, the utility value climbs exponentially. The leading indicators for these outcomes are visible right now. Observers must track the velocity of developer commits on GitHub and watch closely for the official timeline of the HOT token swap. Evaluating the asset requires separating the timeline of current pricing forces from future utility mechanics. Short-term volatility is driven almost entirely by speculation on the HOT token. Price action here is a product of broader crypto macro cycles, ICO-era expectations, and the inevitable friction of development delays. But long-term value belongs strictly to the mutual credit model. Once the bridge to HoloFuel is complete, price is dominated by global compute supply and the organic demand for decentralized hosting against AWS reference pricing. true value in the Holo ecosystem ultimately strips away the cryptographic hype. The network only matters if it can return real economic power to the tangible hardware humming at the edges of the internet.